All right, buckle up. Because today we're diving into a topic that might sound, well, budgeted.
Yeah.
Maybe a bit dry.
Yeah.
But trust us, it's anything but boring.
Yeah. Budgeting doesn't exactly scream excitement, usually.
Right. But today's deep dive is all about budgeting, not just for your personal finances, but for entire organizations.
It's a huge deal in the business world.
Totally. So we're going to take a sack of insights from our sources,
Yeah.
pull out the most important nuggets, give you a shortcut to being truly well-informed about how businesses actually plan their financial future.
Think of it as peeling back the layers.
Exactly. Peeling back the layers to reveal the strategic genius, sometimes, behind the numbers.
And what's really fascinating here, I think, is how budgeting translates that high-level strategic vision, the big picture stuff, into actionable day-to-day operations.
Yeah.
It ensures every dollar and every effort is aligned with where the company wants to go. It's basically the financial backbone of strategic execution.
Okay, let's unpack this then. Before we get into the nitty-gritty numbers, what exactly is budgeting in a business context? How does it fit into that overall strategy? How is it more than just counting pennies?
Right. So at its core, budgeting is part of what we call operational and tactical planning.
Okay.
This is the detailed process of figuring out the specific, measurable objectives and, crucially, the practical means to achieve a company's big strategic plans.
So the how-to.
Exactly. Tactical plans are generally short-term, usually covering, say, up to 18 months, and an annual budget. That's a classic example of this kind of single-use tactical plan.
Big sense.
So essentially, budgets take those grand strategic visions, like become a market leader, and turn them into concrete, period-specific operational guides.
Like a roadmap.
Precisely. We need to sell X units, produce Y units, spend Z dollars to get there, and by placing responsibility for these budgeted goals with specific managers, it helps ensure that achieving those strategic aims becomes, a routine, accountable part of their job.
Not just some idea floating around.
Right. Not just an abstract concept. It makes it real.
So it's not just about setting financial limits, like you said, but making strategy tangible, accountable. What kind of policies do organizations need to put in place for this to actually work effectively, so it doesn't just descend into chaos?
That's a key point. To make budgeting truly effective, organizations really need formal budget policies with a couple of key features.
Okay.
First, there's a strong emphasis on management participation, because budgets typically span a year and involve so many different individuals and departments. Well, the process usually includes a dedicated budget committee.
Ah, okay.
And this committee is crucial. They resolve disputes that inevitably pop up between departments, and they make the final calls on major budget changes.
Got it. Sort of the referees.
You could say that. Second, clear budget guidelines are absolutely essential. Top management needs to provide directives for preparing the budget, and these directives have to be firmly rooted in the company's overarching strategic goals and its long-term plan.
So everyone's working from the same playbook.
Exactly. And these guidelines should also evaluate current conditions, like how are we doing so far this year? What are the goals for the next period? Plus any specific management directives. Without these guardrails, the whole budgeting process can become fragmented and, honestly, way less effective.
Yeah, it sounds like a structured framework is absolutely essential to avoid that chaos and make sure everyone was pulling in the same direction.
Yeah.
But how do they measure progress against these plans? This is where it gets really interesting, I think. Budgets often revolve around standards. What exactly are these, and why are they so crucial?
Right, standards. They're essentially per-unit budgets. Think of it like this. They represent what a single unit of output or activity should cost, or maybe how much material or labor it should require.
Okay, like a benchmark for each little piece.
Precisely. And they're actually integral to something called flexible budgets, which we'll probably get into later.
Ah, okay.
But what's important to note about standards is that they're often deliberately set below current performance expectations.
Oh, interesting. Why?
Well, the idea is to motivate higher productivity and efficiency. It's a bit like setting a challenging but hopefully achievable goal.
Push people a bit.
Exactly. But these standard costs, they aren't static. They need periodic revision, generally once a year, to make sure they accurately reflect changes in technology, processes, maybe input costs.
Right, or they become irrelevant.
Or demotivating, yeah. They lose their power if they're totally out of whack.
Let's dig into the different types of standards then. It seems like there are a few philosophies on how high to set that bar. What are the trade-offs there?
You're right. There are two main types, each with a pretty distinct philosophy. First, you have ideal standards.
Sounds aspirational.
Very. These represent the costs that would result from perfect efficiency and effectiveness. Absolutely no allowance for normal spoilage, machine downtime, human error. None of it.
Wow, perfect world scenario.
Totally. The advantage, supposedly, is this implied emphasis on continuous quality improvement, or CQI. You're constantly pushing for that ideal. But the big disadvantage is they can be very demotivating for employees. If the expectation feels totally unattainable, well, people might just give up or resist.
Yeah, I can see that. Burnout waiting to happen.
It really highlights the psychological aspect, even in seemingly dry financial planning. Then the alternative is currently attainable standards.
Okay, that sounds more realistic.
It generally is. These are based on costs from work performed by employees with the right training and experience, but without requiring, superhuman effort. Provisions are made for normal spoilage, normal downtime.
So building in a bit of reality.
Right. The advantage here is it fosters the perception that the standards are reasonable, achievable. That can significantly boost morale and buy-in.
Makes sense. What's the catch?
The downside is they require more judgment to create. You have to decide what's normal spoilage or downtime. And that judgment call opens the door, potentially, to manipulation if it's not managed carefully.
So it's a balancing act.
Absolutely. A real balancing act between pushing for excellence and keeping employees engaged and feeling like the goals are fair.
That's a fascinating trade-off.
Yeah.
Motivation versus practicality.
Yeah.
So if we're talking about buy-in, who actually gets to set these standards? Does that process itself influence how well they're adopted?
Oh, absolutely. The process of setting standards can be just as important as the standards themselves. And again, there are two main approaches here.
Yeah.
You've got authoritative standards, which are set exclusively by management.
Top down.
Exactly. The advantage, speed. They can be implemented very quickly, and they're likely to include all the relevant costs right from the start without a lot of back and forth.
But the downside?
The big disadvantage is that workers might not readily accept standards that are just imposed on them. You get less ownership, potentially lower performance because they don't feel it's their standard.
Right. Lack of buy-in.
Precisely. The alternative is participative standards.
Okay, collaborative.
Yes. These are set collaboratively by both managers and the individuals who will actually be held accountable to those standards.
That sounds better for morale.
Definitely. The obvious advantage is that workers are much more likely to accept standards they've had a hand in creating. That fosters stronger commitment.
But it probably takes longer.
That's the trade-off. They are generally slower to implement because, collaboration takes time. There's more discussion, maybe negotiation. It's often a strategic choice based on the company's culture and how urgent things are.
Okay, so all these policies, these standards, different ways of setting targets, they all feed into something called a master budget. What is this overarching thing, this comprehensive blueprint?
The master budget, yeah, that's really the mothership. It's the comprehensive blueprint for a company's short-term financial future.
Gotcha.
It goes by other names too, like annual business plan, static budget, sometimes profit planning. Its main purpose is to document specific short-term operating performance goals, typically for a year or less.
So the big plan for the year.
Exactly. It provides coordinated budget guidance for the entire organization, making sure everything aligns with the overall strategic objectives. Now, it generally comprises two main types of budgets.
Okay.
Operating budgets, those are more about the non-financial resources and activities like sales units, production levels, and then financial budgets, which outline the sources and uses of funds, the cash flow.
Right. Operations and money.
Pretty much. And crucially, both are usually prepared assuming a single level of sales volume. That's important. The ultimate output of this whole process is a series of pro forma financial statements.
Pro forma, meaning projected.
Exactly. Projected balance sheet, projected income statement, projected statement of cash flows.
Yeah.
It gives a full picture of the company's anticipated financial position and performance for the period.
That sounds incredibly thorough, like you said, a complete roadmap for the year.
Yeah.
But you mentioned it's based on a single level of activity. Are there rigidities or downsides to that?
Yep.
Especially when business conditions change, which they always do.
Yes, that's a really important point. There are a couple of key limitations of the annual plan or the static master budget.
Okay.
The first is exactly what you hinted at. It's confined to 1 year at a single level of activity. This means the budgeted amounts can end up looking quite different from actual results if sales volume or other activity levels fluctuate.
Even if the cost per unit stays the same.
Right. Even if the underlying relationships between expenses and revenues hold true, For instance, just taking an annual static budget and dividing by 12 to get a monthly budget, that can really exaggerate variances, especially if there's seasonality or big volume swings month to month.
Yeah, that wouldn't capture the peaks and valleys.
Not at all. It's like planning a picnic for a perfectly sunny day but having no backup plan for rain. The second limitation relates to its reporting output.
I saw.
Well, while those pro forma financial statements are familiar and great for external reporting, like to banks or investors, they might not always provide the most useful information for internal management decision-making. Managers often need more granular, real-time insights than those high-level statements offer.
Got it. So useful, but maybe not the whole story for data management. Let's zoom in then on the operating budgets.
Yeah.
These sound like the real workhorses, right?
Yeah.
What do they cover, and how do they actually make the strategy happen day to day?
Exactly. The operating budgets are where the rubber meets the road. They describe the resources needed, materials, labor, time, and how they'll be acquired to meet those strategic goals set out in the master plan.
Okay.
They include several critical components. There's the sales budget, which really kicks everything off. Then production budgets, figuring out how much to make. Selling and administrative budgets, covering all those non-manufacturing costs. And personnel budgets, too.
So where does this whole intricate financial planning process begin? Which one comes first?
It absolutely all starts with the sales budget. This is truly the foundation, the cornerstone of the entire budget process.
Why is it so fundamental?
Because anticipated sales, both in units and in dollars, dictate almost everything else that follows. It's the very first budget prepared.
Okay.
And it drives the development of nearly every other component of the master budget. For example, the number of units in the sales budget. That directly tells the production budget how many units they need to make.
Right. Can't make what you don't plan to sell.
Or shouldn't, ideally.
Yeah.
Similarly, the sales dollars determine the anticipated cash inflows and revenue figures for the financial budgets. Other things like inventory levels, material purchases, operating expenses, they're all coordinated based on these projected sales.
So everything flows from that sales number. How do they come up with it? Crystal ball.
Sometimes it feels like it. But no, the sales budget is built upon a sales forecast. And this forecast uses input from various sources, opinions from the sales staff who are out in the field, statistical analysis of past data, input from line management.
So a mix of data and intuition.
It really is. And they factor in things like past sales patterns, obviously, estimates from the sales force, general economic conditions, what competitors are doing, any price changes the company is planning, changes in the product mix, market research, advertising plans. It's a lot.
Yeah, a lot of variables.
Passionately. Let's take an example. Imagine Innovatco, a growing tech firm, also sells some audio gear. They're putting together their sales budget. They know sales are seasonal, and price and promotions have a big impact.
Okay.
Now, Innovatco has chosen a cost leadership strategy, meaning they focus on lower prices to drive higher volume, grab market share.
Got it. Volume over margin, maybe.
Often, yeah. So for Q1, based on that strategy, they forecast selling 2,500 units at $60 each. That's $150,000 in revenue.
Okay.
In Q2, demand picks up. They anticipate selling 4,000 units, still at $60, bringing in $240,000. Q3 usually dips a bit, so they project 2,000 units, maybe with a promotional price of $50 to keep things moving. That's $100,000. Then Q4, the holiday season spike, they plan to move a massive 10,000 units at $60 again, targeting $600,000.
Big finish.
Yeah. So when you add all that up, Innovatco's total budgeted sales for the year come out to $1,090,000. This really shows how their strategy cost leadership directly impacts pricing and volume and how seasonality shapes the plan. And that number, $1.09 million, now starts to drive everything else.
So that sales budget then kicks off the whole production process, making sure they can actually make the stuff they plan to sell, right? How does that work?
Absolutely. Once you've got those sales targets nailed down, you move straight to the production budget. This budget is usually prepared for each product or department, and importantly, it's stated in units, not dollars initially.
Units to be made.
Exactly. It figures out how many units need to be produced, considering what needs to be sold and what inventory levels the company wants to maintain. It's ultimately comprised of the costs associated with making those units: direct labor, direct materials, factory overhead.
Okay. How do they calculate the number of units?
There's a key formula here. It's budgeted sales in units plus desired ending inventory, beginning inventory, budgeted production in units.
Sales plus what you want left over, minus what you started with.
You got it. That desired ending inventory is a balancing act. You want enough safety stock to avoid running out if sales are higher than expected, but not so much that you tie up cash and space with excess inventory.
Right. Inventory costs money.
It does. Other things influence this too, like company policies on keeping production stable versus fluctuating with sales, the condition of equipment, resource availability, even expected production yields.
Makes sense. Can we run through an example?
Sure, let's stick with InnovateCo. Suppose they want a safety stock of finished goods equal to 30% of the next period's estimated sales.
Okay, planning ahead.
Right. So if their June sales are estimated at 40,000 units and July sales are predicted to be 30,000 units, let's figure out June's production.
Yeah.
Their desired ending inventory for June needs to cover 30% of July's sales. So 30,000 units times 30%. That's 9,000 units they want on hand at the end of June.
Got it.
Their beginning inventory for June would have been the desired ending inventory from May, which would be based on June's sales. So 30% of June's 40,000 units, that's 12,000 units they started June with.
Okay.
Now plug it into the formula. 40,000 budgeted sales for June plus 9,000 desired ending inventory, 12,000 beginning inventory. That equals 37,000 units.
So they need to produce 37,000 units in June.
Exactly. That ensures they meet June sales and have their desired safety stock ready for July.
Okay, from that production plan of 37,000 units, you then need to figure out the raw materials and the people power needed. How do those details get budgeted?
That's right. Those are the next crucial layers, the direct materials budgets and the direct labor budgets.
Okay, materials first.
Yep. For direct materials, you actually have two key budgets. First is the direct materials purchases budget. This tells you the dollar amount of materials you need to buy.
How much to order?
Right. The formula is units needed for production plus desired ending material inventory. Beginning material inventory, units of material to be purchased. Then you multiply those units by the cost per unit.
Straightforward enough. What's the second one?
The second is the direct materials usage budget. This focuses on the cost of the materials actually used in production during the period.
Ah, so what goes into the products themselves?
Exactly. It's calculated as beginning inventory at cost, plus purchases at cost, ending inventory at cost, direct materials usage cost. This is the number that feeds into the cost of goods manufactured.
Got it. And labor.
For the direct labor budget, you're forecasting the hours and the cost of the workers directly involved in making the product. The calculation is pretty simple. Budgeted production in units times hours required per unit equals total hours needed.
Okay.
Then you take those total hours needed and multiply by the hourly wage rate to get the total direct labor wages. This tells you your expected payroll for production workers.
Makes sense. Can we use the InnovateCon example again?
Yeah.
They needed 37,000 units.
Let's do it. So InnovateCo needs 37,000 units. Each unit requires 4 pounds of direct material. Now, new material costs $10 per pound, but they happen to have 48,000 pounds of older material on hand that only costs $9 per pound.
Okay, different costs to track.
Right. And they want a desired ending inventory of 36,000 pounds of material. For labor, each unit takes 2 hours at $20 per hour.
All right, let's see the budgets.
Okay, direct materials purchases. They need 148,000 pounds for production, 37K units by 4 pounds. Add the desired ending 36K, subtract the beginning 48K. They need to purchase 136,000 pounds. At the new price of 10 pounds, that's $1,360,000 in purchases.
Wow, big number.
Tells the purchasing department what they need to do. Now, direct materials usage. Start with the beginning inventory cost, 48K pounds x $9 x 432K. Add the purchases, $1.36. Subtract the ending inventory cost, 36K pounds x $10 equals 360K. Their total direct materials usage cost is $1,432,000. That's the cost hitting production.
All right, labor.
Direct labor budget. 37,000 units times 2 hours per unit means they need 74,000 total labor hours. At $20 per hour, the direct labor budget comes out to $1,480,000. That informs their staffing.
We've covered the direct costs, the materials going in, the labor touching the product. But what about all those other factory costs? Rent, electricity, supervisor salaries, stuff that isn't directly tied to each single unit.
Ah, good question. That's where the factory overhead budget comes in. This budget captures all those fixed and variable production costs that aren't direct labor or direct materials.
The indirect stuff.
Exactly. Things like the electricity for the machines, indirect labor like maintenance staff or supervisors, rent on the factory building, depreciation on the manufacturing equipment. All that goes here.
How is it budgeted? It seems harder to pin down than direct costs.
It can be. It includes both fixed components like rent, which stays the same regardless of production volume within limits, and variable components like electricity, which might increase with more machine hours. This factory overhead is then typically applied to inventory, becoming part of the cost of goods manufactured and sold based on some logical cost driver.
A cost driver? Like what?
Often, it's direct labor hours. The thinking is the more labor hours worked, the more overhead is likely incurred. So they calculate an overhead rate per direct labor hour, for example.
Okay. So for InnovateCo.
Let's say InnovateCo's variable overhead rate is $5 per direct labor hour. We calculated they needed 74,000 direct labor hours, right? So their budgeted variable overhead would be 74,000 hours times $5 per hour, which equals $370,000. They'd also add in their budgeted fixed overhead costs separately. This helps them anticipate and control those often significant, but sometimes overlooked, indirect production costs.
Okay, now that we have all those individual production costs figured out, direct materials, direct labor, and this factory overhead, how do they all finally come together? How do we get the total cost of what's actually being made and eventually sold?
That brings us neatly to the cost of goods manufactured and sold budget. This is where we accumulate all that information from the direct labor, direct material, and factory overhead budgets. It's kind of the grand summation of all production costs for the period.
Pulling it all together.
Exactly. The cost of goods manufactured, or ITM, is simply the sum of those three key elements: direct labor used, direct materials used, and factory overhead applied. This represents the total cost of all the products that were completed during that budget period.
Okay, total cost of finished goods made.
Precisely. Then, to get to the cost of goods sold, or COGS, the cost that matches up against revenue on the income statement you take that cost of goods manufactured, add your beginning finished goods inventory.
Stuff made earlier but not sold yet.
Right. And then you subtract your planned ending finished goods inventory.
Stuff made this period but not sold yet.
Exactly. That final budgeted cost of goods sold amount is super important because it feeds directly into the pro forma income statement. It's what determines your budgeted gross margin sales minus COGS and gives a core view of operational profitability.
Can we see Innovate Keiko's numbers for this?
Sure, let's pull their data. Direct materials used, $1,432,000.
$1,480,000. Variable factory overhead, $370,000. Let's assume $300,000. Beginning finished goods inventory, $1 million. Ending finished goods inventory, planned, $750,000.
Okay, got it.
First, calculate the total cost of goods manufactured, COGM. Sum up materials, labor, and both variable and fixed overhead. $1,432,000 plus $1,480,000 plus $370,000 plus $300,000, $582,000. That's the cost of everything they finished making.
Okay.
Now for the cost of goods sold, COGS, start with COGM, $3,582,000. Everything they could have sold. Right. Then subtract the planned ending finished goods, $750,000. Their final budgeted cost of goods sold is $3,832,000. That's the number that hits the income statement against their sales revenue.
Got it. That ties production costs directly to sales. And finally, what about all the other expenses? The stuff not directly tied to making the product, like marketing, the CEO's salary, the accounting department?
Ah, yes, the selling and administrative, or S&A, costs. Those fall under the selling and administrative expense budget. This budget captures all the anticipated non-manufacturing expenses for the period, both fixed and variable.
So everything outside the factory, basically.
Largely, yes. And unlike direct materials or labor, which get attached to inventory, these S&A expenses are budgeted as period costs, meaning they're expensed directly in the period they occur, regardless of how many units are produced or sold. Think of your monthly office rent or advertising spend. It hits the income statement that month.
It doesn't become part of the product cost.
Yeah, exactly. Typical components include variable selling expenses, things like sales commissions, maybe delivery costs, sometimes bad debt expenses, which tend to fluctuate with sales volume.
Okay.
Then fixed selling expenses like base sales salaries, advertising campaign costs, depreciation on, say, salespeople's cars or showroom fixtures. These tend to be more stable month to month.
Right.
And finally, general administrative expenses, which are usually all fixed. This covers administrative salaries like HR, finance executives, accounting and data processing costs, depreciation on office furniture and equipment, legal fees, stuff like that.
The overhead of running the business itself.
Precisely. Getting this S&A budget right is crucial because these costs can really eat into profits if they're not managed effectively, no matter how efficient your production is.
Okay, so the operating budgets tell us what we're going to do, how much we'll make, and what all the operational costs are. But, like we said earlier, none of that matters if you don't actually have the money to pay the bills when they come due. How do companies make sure they have the cash? This is where the financial budgets come in, right?
Exactly. This is where the financial rubber truly meets the road. We move into the realm of cash budgets.
The king of budgets.
Many would say so. A cash budget provides detailed projections of both expected cash receipts, inflows, and cash disbursements, outflows, over the budget period.
So tracking the actual cash movement.
Precisely. It's derived directly from all those operating budgets we just discussed. But it's layered with specific assumptions about when cash is actually collected from sales and when cash is paid out for expenses and purchases.
Because sales don't always equal immediate cash.
Almost never, if you have credit sales. The purpose here is critical. Give management a forward look at the availability of funds. Do we have enough cash to pay dividends, repay debt, make needed investments? Or are we going to be short? Cash budgets are generally broken down into three main sections: cash available, cash disbursements, and financing.
All right, let's start with cash coming in. What are the key elements there, and how do companies forecast those inflows with any accuracy?
So cash available typically starts with your beginning cash balance, what you have in the bank at the start of the period. Then you add your projected cash collections.
Collections, not sales.
Key distinction. Cash collections are the amounts you actually expect to receive in cash during the period. This comes mainly from sales, based on the sales budget, but also includes any anticipated loan proceeds or asset sales.
How do they estimate sales collections?
They develop collection patterns based on historical data. For credit sales, they'll estimate what percentage do we typically collect in the same month as the sale, what percentage the month after, 2 months after, what percentage realistically might become bad debt and never be collected.
So applying probabilities based on past experience.
Exactly. This forecasting is vital. You could have record sales, but if your collections lag badly, you can face a serious liquidity crisis.
Yeah, cash flow problems, even when profitable on paper.
It happens all the time. Let's use InnovateCo again. They need their cash budget for September. Their historical data shows 80% of credit sales are collected the next month, 18% are collected the second month after sale, and sadly, 2% are usually uncollectible.
Okay.
They're relevant sales data. July, credit sales, $850,000. August credit sales, $925,000. September credit sales, $700,000. Won't be collected until October mostly. September cash sales, $170,000 collected immediately.
Got the numbers. How much cash comes in during September?
Okay, let's calculate September's collections. From July's credit sales, $850K, they'll collect 18% in September. 2 months later, that's $153,000. From August's credit sales, $925K, they'll collect 80% in September. 1 month later, it's at $740,000. And then add September's direct cash sales, $170,000. So InnovateCo's total cash collections for September, $153,000 plus $740,000 plus $170,000 plus $1,063,000. That detailed timing is crucial for knowing when the cash actually hits the bank.
Okay, we've got the cash coming in forecasted. What about the cash going out? Where do companies typically see their biggest outflows, and how do they budget for the timing of those payments?
Right, the other side of the coin, cash disbursements. These are all the anticipated cash outlays for materials purchases, payroll, operating expenses, capital expenditures, loan repayments, dividends, taxes, everything going out the door.
Often where the surprises hide if you're not careful.
Definitely. For purchases, the budget shows the amount expected to be paid for direct materials and other goods. This isn't necessarily the same as when the materials were ordered or received. It depends on payment terms.
So managing accounts payable timing.
Exactly. It includes cash purchases made now, payments for credit purchases made earlier that are now due. This forecast relies on understanding typical payment cycles and supplier terms.
And operating expenses.
Similar logic. The cash disbursement budget shows the amounts actually paid out for operating expenses during the period. Critically, you have to eliminate any non-cash expenses from this calculation, like depreciation. Depreciation reduces profit on the income statement, but no cash actually leaves the building.
Good point.
You include payments for expenses incurred in prior months that are due now, current month expenses paid immediately in cash, but you exclude current month expenses that won't be paid until a later period, like accrued payroll paid next month.
So it's all about the timing of the actual cash movement.
Precisely. Let's stick with InnovateCo and forecast their September cash disbursements based on these costs.
$425,000. These were purchased back in August, but payment is due in September.
$310,000.
Yeah.
Incurred in Sept, payable in Sep.
$150,000 incurred and payable in Sep.
$35,000 incurred and payable in September.
$35,000 scheduled payment to shareholders, They have no tax payments due in September.
Okay, what's the total outflow? Adding those up. 425K plus $310K plus 150K plus 145K plus 35K. Innovate Coot's total cash disbursements for September are projected to be $1,185,000. That gives them a clear picture of expected cash leaving the company.
So you combine the cash projected to come in, $1,063,000, with the cash projected to go out, $1,185,000. And then you might need to adjust, right, if there's a shortfall or maybe even a big surplus. That's where the financing section comes in.
Exactly right. The financing section is the third critical part of the cash budget. It considers how the company will manage its overall cash position, usually against a target minimum balance.
Like a safety net.
Precisely. If the projected cash inflows minus outflows result in a balance below that minimum target, this section outlines how the company plans to borrow, maybe draw on a line of credit to cover the shortfall.
And if there's extra cash?
Conversely, if there's a projected surplus significantly above the target, this section might detail plans to pay down debt or make short-term investments to put that excess cash to work. It's the balancing mechanism.
Okay, let's put it all together for InnovateCo in September. We have the inflows and outflows. What else do we need?
We need their beginning cash balance and their desired ending balance. Let's say InnovateCo forecasts a beginning cash balance for September 1st of $80,000. And management policy dictates they want an ending cash balance of at least $50,000.
Okay, $80K start, minimum $50K end.
Now, we saw their collections are $1,063,000, and their payments are $1,185,000. Let's run the numbers for their combined cash budget. Start with beginning cash balance, $80,000. Add cash collections, plus $1,063,000. That gives total cash available, $1,143,000.
Yeah.
Now, subtract cash payments. Negative $1,185,000. This results in an ending cash balance before financing of $42,000.
Negative $42,000, below their minimum target.
Way below. This immediately flags a problem. They need cash. Now, the financing section kicks in. Let's say their plan is to borrow $95,000 at the end of September from their line of credit. Assume the interest rate is 6% annually, but the first interest payment isn't due until October 31st.
So they get the cash now, pay interest later.
Right. So in the financing section for September,
Thus, $95,000.
$0, not due yet.
Yep.
Repayments, a principal,
Yeah.
$0. No principal repayment plan this month.
Okay.
Now, take that pre-financing balance of $42,000 and add the net financing of plus $95,000. Their final projected ending cash balance for September is $53,000.
Just above their $50,000 minimum target.
Exactly. The cash budget, especially the financing section, showed them the impending shortfall and allowed them to plan the necessary borrowing to maintain liquidity and meet their policy target. Without it, they might have bounced checks.
Wow, okay. So that cash budget is incredibly powerful for day-to-day survival. Beyond just managing the cash, how do all these individual operating and cash budgets finally come together to paint that full financial picture? You mentioned the pro forma financial statements earlier.
Right. All these detailed budgets, sales, production, materials, labor, overhead, S&A, cash, they all culminate in the pro forma financial statements. These are the projected financial statements for the budget period, the ultimate output of a whole master budgeting process.
The big summary reports.
Essentially, yes. First, the pro forma income statement. Its key components are pulled directly from the budgets we've discussed. The sales budget provides the top-line revenue. The cost of goods sold budget gives us, well, the cost of goods sold. The selling and administrative expense budget accounts for those period operating costs. And importantly, any projected interest expense, which we'd calculate based on the financing activity shown in the cash budget, is also included here. This all flows down to a projected net income or loss for the period.
Okay, so it shows the projected profitability.
Exactly. Next, the pro forma balance sheet. This displays the projected balances for all assets, liabilities, and equity accounts at the end of the budget period.
A future snapshot of financial position.
Precisely. These balances have to be consistent with everything planned in the income statement and the cash budget. They're adjusted for all the planned cash collections and disbursements, inventory changes, asset purchases, debt changes, and non-cash transactions like depreciation.
So everything ties together.
It has to, or the budget doesn't balance. Finally, there's the pro forma statement of cash flows. This is derived from the budgeted income statement and the changes between the previous actual or budgeted balance sheet and the current pro forma balance sheet.
Yeah.
And critically, it must reconcile back to the ending cash balance calculated in the detailed cash budget.
What's the extra value of this statement if we already did the cash budget?
Good question. It categorizes the cash flows into operating, investing, and financing activities, just like a regular statement of cash flows. This provides a clearer picture of where cash is coming from and where it's going in broader strategic terms. It helps identify if additional financing might be needed beyond just operational shortfalls and helps evaluate decisions around things like payment terms, trade credit.
Got it. Provides a different perspective on the cash movements. And what about those really big long-term purchases, like building a new factory or buying a whole other company? Those don't seem like they'd fit neatly into an annual operating budget.
You're absolutely right. Those are handled separately, typically in capital budgets. These budgets focus specifically on identifying, evaluating, and planning for an organization's major capital additions or investments, often spanning multiple years.
The big strategic bets.
Exactly. They detail the planned expenditures for things like new facilities, major equipment upgrades, launching entirely new product lines, or other significant long-term investments. Because these involve large sums of money and long-term commitments, they're highly dependent on the company's overall financial health, cash availability, and creditworthiness. They represent the company's investment in its future growth and capabilities, separate from the day-to-day operating cycle.
Okay, that makes sense. Now, going back to the master budget, it sounds incredibly thorough, but we talked about its rigidity being based on one level of activity. If conditions suddenly change mid-year, like an unexpected recession hits or a competitor launches a killer product, that static budget might become, well, not very useful. Is there a way to make budgeting more adaptable?
That's an excellent point and a common challenge. And yes, there is a way. Flexible budgeting.
Okay, sounds promising. What is it?
A flexible budget is essentially a financial plan prepared in a way that allows for easy adjustments based on changes in the actual volume of production or sales.
So it flexes with activity levels.
Exactly. It's designed to accurately reflect what costs should have been for the actual level of output achieved, rather than just comparing actual results to the original static plan, which might have assumed a totally different volume. Think of it as an adjustable economic model for costs and revenues.
Building in the what-ifs from the start.
Pretty much. It allows you to say, okay, we plan to sell 10,000 units, but we only sold 8,000. What should our costs have been for 8,000 units? Then you can compare that flex budget to your actual costs for a much more meaningful variance analysis.
So it helps isolate true efficiency issues from just volume differences. What are the core assumptions that make a flexible budget work?
The core assumptions revolve around understanding cost behavior. You need to know your revenue per unit, your variable costs per unit, costs that change directly with volume, and your fixed costs, costs that stay the same within a certain range of activity.
And that range is important.
Very important. That's called the relevant range. It's the specific activity span, say, from 8,000 to 12,000 units produced, where those assumptions about revenue per unit, variable cost per unit, and total fixed costs are expected to hold true. Outside that range, cost behaviors might change. For example, you need to rent more space, driving up fixed costs, so the flexible budget formulas might need adjustment.
Okay, so identify cost behaviors within a relevant range. What are the big wins of using a flexible budget? And are there potential pitfalls or limitations? It sounds powerful, but maybe tricky to implement.
The primary benefit is definitely improved performance evaluation and control. As we said, it allows managers to compare actual results to a budget that's adjusted for the actual activity level. This helps pinpoint real areas of efficiency or waste, rather than just explaining everything away as, well, volume was different.
Apples to apples comparison.
Exactly. It provides much better insights for corrective action. However, there are limitations.
Such as?
Flexible budgets are highly dependent on, first, the accurate identification of fixed versus variable costs. In the real world, some costs are mixed, and classifying them correctly takes effort and analysis. Second, they depend on the precise determination of that relevant range. If your assumptions about cost behavior or the relevant range are off, the flexible budget won't be accurate, and the variance analysis it produces could be misleading.
So garbage in, garbage out applies.
As always in accounting, let's illustrate with InnovateK's exercise equipment division. Their original master budget anticipated making and selling 5,000 units. Selling price is 60 unit. Variable costs, materials, direct labor, variable overhead are 40 unit. Fixed costs, rent, salaries, etc. are $100,000 per period. And their relevant range, where these numbers hold true, is from 4,000 to 6,000 units, 20% below and above the master budget level. Got the setup. Now let's use a flexible budget approach to see the projected income at different volumes within that range. If activity drops to 80% of master budget, 4,000 units. If activity drops to 80% of master budget, 4,000 units. Sales, 4,000 x 60 equals $240,000. If activity drops to 80% of master budget, 4,000 units. Variable costs, 4,000 x $40 equals $160,000. If activity drops to 80% of master budget, 4,000 units. Contribution margin, $80,000. If activity drops to 80% of master budget, 4,000 units. Operating income equal $20,000 loss.
Ouch. Low volume hurts.
It does. Now, at the master budget level, 5,000 units. Sales, 5,000 x 60, $300,000. Variable cost, 5,000 x 40, $400,000. Contribution margin, $100,000. Fixed cost, $700,000. Operating income equals $0. Break even.
Okay.
Finally, if things go well, at 120% of master budget, 6,000 units. Sales, 6,000 x 60 equals $360,000. Variable cost, 6,000 x 40, that's $40,000. Contribution margin, $120,000. Fixed cost is $100,000. Operating income equals $20,000 profit.
So the flexible budget clearly shows the direct impact of volume changes on the bottom line, holding cost efficiencies constant.
Exactly. It immediately shows management the financial implications across a range of likely activity levels. It allows them to anticipate potential losses or profits based on volume fluctuations and react more proactively, rather than just being surprised by variances against a single, rigid, static budget number. It empowers much better decision-making when faced with uncertainty.
So wrapping this all up, what does this journey mean? We've gone from that high-level strategic vision all the way down into the weeds of cash flow forecasts, material purchases, and adapting plans with flexible budgets. We've really peeled back those layers.
It means, I think, that budgeting is far, far more than just a bean counting exercise. It's truly an organizational communication tool. It's a performance measurement system. And it's a critical component for actually achieving strategic objectives, especially in the dynamic, often unpredictable environments businesses operate in today.
Yeah, it connects the big goals to the daily grind.
Precisely. It's the mechanism that translates those sometimes abstract goals into concrete actions and, importantly, measurable results everyone can track.
Exactly. And it's that dynamic quality, especially with things like flexible budgeting, that makes it a living document, doesn't it? Something that guides decisions, motivates teams, helps companies navigate those choppy market waters, rather than just being a static report filed away somewhere.
Couldn't agree more. It really forces alignment across the entire business.
It really does show how every single part of a business needs to be connected and pulling in the same strategic direction. So for you, our curious learner listening in, maybe consider this. How might understanding these different budgeting philosophies, ideal versus currently attainable standards, or that top-down authoritative approach versus the participative one, how might that change the way you approach setting goals, whether it's in your personal life or maybe a team project at work? And thinking about our discussion today, what stands out to you as the most surprising insight about just how detailed companies get with this stuff, and maybe why that level of detail is so absolutely vital for turning big strategies into actual reality? Something to chew on.